Two people each put $100,000 into the stock market. Same age, same salary, same 30 years ahead of them. The only difference is a single decision. The first one wants to get paid, so he builds a portfolio of high dividend stocks yielding around 3%. Real cash landing in his account every quarter. Money he can see. The second one does something that feels almost lazy. She ignores the dividend entirely. She just buys the whole market and never once checks the yield. 30 years later, one of them is sitting on almost $400,000 more than the other. And it's the woman who never looked at yield. If you own dividend stocks because someone told you that's how you get paid while your money grows, I need you to watch the next few minutes before you buy another share. I'm not here to burn dividends to the ground. I hold some myself. I'm here to put one number on the table, the number that quietly decides this entire contest, and then step back and let the math do the arguing. So let's name the thing most people quietly get backwards. Yield and total return are not the same number, and confusing them is what costs you the $400,000. Yield answers one question. Of the money I have invested right now, how much is the company handing back to me this year? 3% yield on $100,000 is $3,000 in your pocket. That's it. That's all yield tells you. Total return answers a completely different question. How much bigger did my pile actually get? Price gains, dividends, everything, added up. That's the number your future depends on. A dividend doesn't fall from the sky on top of your growth. When a company pays you $1, its own value drops by roughly that same dollar the moment the payment leaves the door. You didn't gain $1, you moved $1 out of the stock into your hand, where the taxman can finally see it. The whole video runs on that one distinction. Everything after this is just watching it play out with real money. Let's give them names, because this is going to get personal. The dividend investor is Marcus. The index investor is Dana. I want you to understand how identical these two people really are, because that's the whole point. They're both 35. They both earn the same salary. They both have exactly $100,000 to invest today, and neither of them will add another cent for the next 30 years. No monthly contributions, no windfalls, nothing. They both leave the money completely alone until they turn 65. They both reinvest every dividend they receive. They're even in the same tax situation, the ordinary one, where qualified dividends and long-term gains get taxed at 15%. One decision separates them. Marcus picks his investments by yield. He wants the roughly 3%, the steady cash. Dana picks the entire market and accepts whatever it pays, which is closer to 1%. Same money, same discipline, same 3 decades. One variable. Hold on to how small that difference feels right now, because Marcus is about to spend 29 years feeling like he made the smarter, safer call. Here are the returns I'm giving them, and I want to be upfront about it. Dana's total market compounds at 10% a year. That's roughly the long-run average with dividends reinvested. Marcus's high dividend portfolio compounds at 9%, 1 point lower. That gap is deliberately gentle. Over the last decade, the real spread between a total market fund and a high dividend fund ran closer to 3 points, not 1. I shrank it to 1 on purpose, so no one can accuse me of stacking the deck. If anything, I'm being kind to Marcus. Now let it run. For the first 15 years, honestly, you'd barely notice. Marcus watches his dividends land every quarter and feels good about it. He's convinced he's the responsible one. He just doesn't know what that one missing point is doing underneath the surface. 30 years in, they both cash out. Dana's total market position is worth about $1.5 million after she pays the tax on her gains. $1.45 million, to be exact. Marcus, with his steady, comforting dividends, walks away with about $1.05 million. Same 100,000, same 30 years. A gap of nearly $400,000, and Marcus never felt it happen. So where does Marcus's money actually leak out? 2 places, and neither one is dramatic. That's exactly why they're so easy to miss. The first leak is the companies themselves. To get that 3% yield, Marcus has to tilt his portfolio toward older, established businesses, utilities, banks, consumer staples. Mature companies pay out big because they've run out of exciting places to put the money. That's fine. But it means Marcus is systematically underweighting the younger, faster-growing companies that do the heavy lifting on price appreciation. He's not buying bad businesses. He's just buying the ones that hand money back instead of the ones that multiply it. Every year he chooses the payout, he quietly passes on the growth. The second leak is the tax. Every dividend Marcus receives gets taxed the year it lands, even the ones he reinvests immediately. He never actually touches that money. It goes right back into the market, but the 15% comes out first, every single year, for 30 years. Add it all up, and Marcus hands the government about $61,000 in dividend taxes over his lifetime. Dana, whose fund barely pays a dividend, hands over about $31,000. Her gains just sit there compounding, untaxed, until the day she sells. Marcus is paying rent on his growth the entire way up. Dana defers hers to the very end. Here's the part that surprised me when I actually ran it. Most people, when they hear this, blame the taxes. The dividend tax is the obvious villain. You can see it. It stings every year. So let's find out how much of that $400,000 gap the tax is really responsible for. I reran the whole thing with one change. I gave Marcus and Dana the exact same 10% return. Identical growth. The only thing left different is that Marcus still pays tax on his bigger dividend stream every year, and Dana still gets to defer hers. Pure tax drag, nothing else. The gap in that version? About $74,000. Real money. But it's not $400,000. It's less than a fifth of it. So where did the other $320,000 come from? The 1 point of return. The growth Marcus quietly gave up, year after year, by picking companies for their payout instead of their total return. The tax is the splinter. The tilt is the amputation. And that's the number this whole video was built to hand you. A dividend is not extra money bolted on top of your growth. It's just a slice of a return you were already going to get, served early, and taxed on the way. Marcus spent 30 years optimizing the size of the slice. Dana spent 30 years optimizing the size of the pie. Now let me argue against myself for a minute, because this model has real limits and you deserve to hear them. First, the taxes. Everything I just showed you happens in a regular taxable account. Move both of them into a 401k or a Roth, where nothing gets taxed along the way, and Marcus's yearly tax leak vanishes completely. So the gap closes, right? It doesn't. Run it inside a Roth and Dana still ends up more than $400,000 ahead. Because the tax was never the main event. The growth was. Sheltering the account fixes the splinter and leaves the amputation. Second, and this is the honest weak point in my own case, that bigger piece of the gap only exists because I assumed high dividend stocks return 1 point less per year, forever. That's not a law of physics. There have been long stretches, decades, where value-leaning, dividend-heavy stocks matched or even beat the broad market. If that era comes back, most of this gap shrinks. That's the exact reason I used 1 point instead of the 3 points we've actually seen lately. I wanted the case to survive even if I'm wrong about the future. And third, the thing the math can't score. When Marcus retires, those dividends show up as cash whether the market is up or down, and he never has to sell a share in a crash to eat. That's not nothing. For some people, a check that arrives no matter what is worth giving up some final net worth for. The math says Dana wins. It doesn't say Marcus is a fool. So what do you actually do with this? 4 moves, and you can run all of them before this video ends. 1. When you compare any two investments, cover up the yield with your thumb and look only at total return. If a stock or fund can't win on total return, a fat dividend is just consolation. 2. In your taxable account, lean toward the broad low-yield index and let the gains defer for as long as possible. Every year you don't trigger a tax is a year your money keeps compounding on the government's behalf and yours. 3. If you genuinely love dividends, hold the dividend payers inside your 401k or Roth, where that yearly tax simply doesn't apply. Same income, none of the drag. And 4. The one almost nobody uses. If you ever need cash from Dana's index fund, you just sell a sliver of it. You build your own dividend, on your own schedule, and you only get taxed on the tiny bit of gain inside what you sold, not the whole payment. It's a dividend you control, instead of one that controls your tax bill. So remember Marcus and Dana. Same $100,000, same 30 years, same discipline. The one who never once looked at yield finished with nearly $400,000 more, because she was optimizing total return the entire time, and Marcus was optimizing a number that was never going to build the wealth on its own. If this changed how you see that dividend hitting your account, the calculator I use to run every one of these numbers, taxable versus Roth, 1 point of drag versus 3, is sitting in the member vault, and you can plug in your own portfolio. Give this a like if the pie versus slice thing finally clicked, and subscribe if you want to run the next number together. Because there's always a next number.